Good morning, everyone, and welcome to Julius Baer's Moving Markets podcast. It's Friday, the 13th of February, and my name is Helen. My first guest this morning will be Lucija Caculovic, and I'll be asking her about what we saw in financial markets yesterday. And I'm delighted that we also have Tim Gagie on the podcast this morning, as usual on a Friday, with his weekly update on FX and metals. But let's dive straight into what's been happening in the markets. We saw a fairly mixed picture yesterday, particularly in Europe, alongside some concerning drops in US equities. With me today to unpack these moves is Lucija. Good morning, Lucija. Thanks for joining me.
Good morning, Helen.
So let's start with the European markets. The Stoxx 600 ended marginally lower yesterday, despite some positive corporate news. Can you elaborate on this for us first, Lucija?
Yes, it was a tale of two sides. So Siemens boosted its outlook, highlighting the positive impact of AI investments in industrial applications. Luxury brands like Hermès also performed strongly, driven by robust sales in the US and Japan. And we also witnessed a remarkable spike in shares of Schroders, the UK asset manager, after Nuveen announced a takeover bid, creating one of the world's largest fund managers. However, we also saw disappointments. Adyen, the fintech firm, suffered a considerable drop despite increased revenue, and Unilever spin-off Magnum ice cream saw profits plummet. Mercedes-Benz also reported a significant dip in operating profit, citing challenges in China and global tariffs.
Turning our attention now to the US markets, it was a challenging day overall, with major indices sharply lower. Can you walk us through what drove the sell-off?
Yeah, the main issue remains this widening sense of uncertainty around AI. We talked about this before on the podcast. It's no longer just a story about software or chip makers. We're now seeing concerns spill over into real estate, trucking, logistics, and more traditional networking companies. Now, all of the Magnificent Seven ended lower. Apple had its biggest daily drop since Liberation Day, and Cisco also fell sharply on disappointing guidance. The bright spots were really the defensive sectors, so healthcare, consumer defensives, aerospace, and defense. And Helen, we shouldn't forget that despite the wobble, the broader market is still sitting near record highs.
Looking beyond the main indices, were there any standout movers in after-hours trading that caught your eye?
The after hours were lively. Applied Materials jumped more than 10% after posting strong numbers and upbeat guidance. Airbnb also traded higher on positive expectations. Pinterest, however, fell roughly 17% after missing expectations and issuing a soft outlook.
All right, now let's talk commodities. Silver took a notable hit yesterday and gold also softened. What's driving these moves?
Well, both metals have been under pressure this week after strong US labor data took the urgency out of rate cut expectations. Yesterday, we saw gold break below that important $5,000 level, which triggered additional selling, and silver followed the same pattern. But that said, both have recovered a bit this morning. And talking about commodities, oil prices experienced a considerable decline yesterday, largely driven by increasing supply signals. We had talk of potential US sales of Venezuelan oil to China, suggestions that Russia could return to dollar-based trade, and indications that Venezuela may grant more licenses to Chevron and Repsol.
Turning to the bigger economic picture, we received some sobering news on the US housing market. Existing home sales plunged in January. Is this a temporary blip or something more systemic?
It looks more structural than temporary. The 8.4% fall in existing home sales brings us back to levels we last saw in late 2023, and analysts are calling it a new housing crisis. High prices, limited inventory, and shaky confidence are all feeding into weaker demand. Mortgage rates aren't helping either, and while winter storms might have pushed some closings into February, the broader trend is clearly downwards.
On the subject of macroeconomics, the impact of the recent surge in US tariffs is becoming increasingly apparent. Reports suggest American businesses and consumers are bearing the brunt of these costs, despite initial claims to the contrary.
Yes, that's right. So the Trump administration suggested foreign exporters would absorb the tariff burden, but new research shows that about 90% of those costs are actually being borne by US importers and ultimately US consumers. Now, for households, that's effectively an extra 1,000 to 1,300 US dollar per year in higher prices.
Okay, now just quickly looking at Asia, overnight ahead of next week's Lunar New Year break, Asian shares retreated from their record highs as the US tech worries spilled over. But we also saw news that the US and Taiwan have finalized a trade deal. Now looking ahead, lastly, Lucija, what key data releases should investors be focusing on today?
We'll shortly see the Swiss Consumer Price Index for January, followed by Eurozone GDP estimates and trade figures. But the real focus will be on US CPI this afternoon. That's the one investors will be watching closely for any hints about the Fed's next steps. Finally, Helen, US stocks futures were trading in the red when I last checked, so we may be in for a tougher start to the session later on.
All right. Thank you very much, Lucija, for the great roundup this morning.
Thanks for having me.
And now over to you, Tim. Good morning, firstly.
Good morning, Helen.
I imagine you were hoping to open with something else today, but I think we have to start with metals again, don't we?
Yep, plus ça change, as they say here in Geneva. It all looked so orderly for most of the week, and we were all hoping to find a base at 5,000 in gold and maybe even 80 in silver, and maybe we still will. But it looks like the liquidations weren't done yet. Volume suddenly increased, and we eventually saw more than a 10% drop in silver yesterday from high to low, with slightly smaller but nonetheless significant moves in the other metals. Next week is Chinese Lunar New Year, so there's going to be a lot of markets closed over there. Plus, Monday's a US holiday, so we might also have been seeing some adjustments and protection ahead of the period. We have generally preferred to try and take a bit of exposure using derivatives in metals since we had the big collapse. Vol remains high, and the entry point on reverse convertibles, accumulators, bullish TARFs and the like are generous, but they are also generous for a reason. So I would be very careful not to chase the market, over leverage. Positioning is the key, but I do think that here there are one or two interesting opportunities, but I also think that they should be taken cautiously. We can't say we are out of the woods quite yet, much as we might have liked to.
Earlier in the week, we saw US payrolls data, which came out on the strong side, but the dollar didn't react much. What do you see next for the dollar, Tim?
Yeah, the reaction was quite muted. I think there's a lot of understandable mistrust of US data as well. Conveniently, President Trump was delighted with the data, choosing to hold off on his usual criticism of manipulation and whatnot, and preferring to stick to his line of imagine what it would look like if rates were 2% lower. Next Fed meeting is still quite some way away, over a month, so plenty of speculation remaining, but a bit early to have any clear ideas. I'm still not really convinced by this idea of aggressive dollar selling. To me, it looks more likely that we will continue to be stuck in the ranges in the majors. Euro-dollar got a bit of vertigo above 120. The ECB also not so happy with it up there, while cable is back to the 136 level, understandably so. The general dollar bounce also saw a little bit of a pullback in Aussie dollars, Norwegian kroner and the like, so I think there's some interesting opportunities there, especially if you don't yet have any exposure to the Australian dollar, where we do have a fairly positive view. Emerging markets still interesting. I've spoken about this before, but since January 2025, the performance of the Brazilian real, South African rand and Mexican pesos against the euro is between 2% and 5%. It's pretty minor compared to what happened with the dollar. But when you pull in the carry or the interest rate advantage, you get more like 12% to 20% depending. So instead of buying euro dollars up here, if I want to sell dollars, I might prefer to do it a little bit in some emerging market and at least capture some decent yield.
Apart from metals, low yielders were also in the spotlight. The Swissy and yen both strengthened. Is there more to come?
Yeah, maybe. I don't know. I mean, year to date, the Swiss franc and the yen are bang in the middle of the pack, and they're well behind the Aussie, Kiwi and Scandis. But this week is a bit different, and especially for the yen. Maybe now the elections in Japan are out of the way, at least we stop selling the rumours. I'm just not sure we should really be buying the fact. Dollar yen is a bit distorted because you have the dollar fluctuations. Euro yen did get back down to just below 182, which is the first time this year. And the yen even outperformed the Swiss franc a little bit this week. But I'm skeptical that we will see a meaningful recovery in the yen. I still think some people are stuck on the wrong side of that and will be more inclined to sell into yen strength. The Swiss franc is now at really stretched levels. I know I probably keep saying that, but I mean, below 105 against the pound, it's almost 91 against the euro, and of course 77 against the dollar. These aren't really normal levels, and I don't see how we can stay here. I think if you have a bit of room to take a position here, the levels are very interesting, and maybe something a bit more exotic, like, I don't know, selling a put on dollar Swiss with a knockout, it's an American knockout, you might get a quick exit, although I would be pretty light on the positioning there. Finally, Helen, I went to the doctor the other day, and he said, Tim, you've got hypochondria. I said, oh, come on, not that as well.
Very good. Thank you, Tim, for the great update, as always. So that is all for today. Thank you again to my guest this morning, and thank you all for tuning in. Please subscribe to our show if you enjoy it, and you can, of course, also leave us a review on whichever platform you like to listen on. So we'll be back again on Monday morning. Do join us then when Bernadette will be back as your host, and she'll be joined, as always, by more of our colleagues to talk about what is moving markets. But until then, I wish you all a great day and then a great weekend. Bye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.